Happy afternoon once again. So it's 3:05. Let's start. I thank you all, the participants attending here and who have also registered but would be attending in due course. I thank you all for attending our webinar from Anvision Business Solutions. And today's topic is about navigating overseas direct investments. And this session, I'll be taking along with my colleague Maithili.
Good afternoon, all.
Yeah, she can add. So a brief about us. It's a boutique consulting firm, an offshoot of 53-year-old, 57-year-old, I would say, CA firm. And we advise on financial and regulatory solutions in a holistic way. And we believe challenges may come from anywhere, but solutions should come from or can come from us. And we strive for solutions from us or through us. And as part of our offerings, we provide the following services. I'll touch upon briefly. It's transaction advisory services, valuations, tax advisory, FEMA advisory, corporate structuring and restructuring matters. We advise on these are all on the business side and the entity side. On the personal front, we advise on estate planning and private trusts. We advise on setting up effective management information systems. We undertake due diligences. We provide virtual CFO services and corporate law matters. These are the ones we undertake. These are the services we take up under Anvision banner. Coming to the today's topic, of course, it is overseas direct investment, and we felt it is all the more important to have an expert on board who will be sharing his practical exposure that he has over a period of time, and we felt it is very important because we from professional side we have certain views, but he being in banking sector and practicing FEMA from banking sector's perspective, he will have certainly much more value added points that to share today with us. And so I would want to thank Mr. Mohammed Qadir Abdullah. Just a brief about him. He has 30 years of banking experience in FEMA advisory and compliance. He has managed Forex, capital account transactions, corporate banking, financial markets, and trade and cash solutions. He's a senior associate director, who at present at Standard Chartered Bank. He's a certified associate of Indian Institute of Bankers. His past experiences have been he has a stint in Oriental Bank of Commerce, Bank of India, and his main expertise, as we understand, we have worked with him in the past, we are aware of, which is FEMA, Forex, and corporate banking. And certainly he collaborates also with other top consulting firms. And he's also a corporate trainer and speaker with 10 years experience. Along with him, we have Radhika Chandak, who is also one of the senior members in Standard Chartered. She heads corporate banking practice. So I wholeheartedly welcome Mr. Kader and Ms. Radhika. Mr. Kader, you're able to speak, Mr. Kader?
I think we'll have to
Okay.
provide,
Unmute him.
yeah.
You can unmute Mr. Kader.
Yeah. So thank you very much for giving me an opportunity to invite this webinar to give us a practical insight on the FEMA perspective. Yeah, definitely. I'm looking forward to work with you and the team.
Thank you. Thanks, Mr. Kader. Radhika, do we have you here? If you can speak few words. Just a minute, my colleague will unmute you so that you can unmute yourself and put your video on also.
Yeah, hi everyone. So I'm a part of Standard Chartered Bank into the corporate division. We have been working with Suresh and Co and Anveshan for a very long period, and it's our privilege to work with them, and we are really happy to be a part of this session right now. And yeah, we will take it forward. And then one of my senior resource also would join in couple of minutes to pitch our proposition as well.
Thank you.
Thank
Thanks,
you, Arun.
Radhika,
Yeah.
for being here. It's privilege, our privilege. Thanks, Mr. Kader. So, friends, the structure would be that we'll take you through the concepts quickly, and during we speak about the concepts and the regulations, we will also try to identify. We have identified the issues or the roadblocks or the concerns which we have come across in our past practice experiences. And during this, I'll also call upon Mr. Kader to share his expert view. So while we complete our presentation in this mode, post which we will also have a Q&A session. We'll try to limit our presentation to next 50 minutes or so and try to have more on Q&A, because I know ODI is something very, very practical, and we come across in our daily life, be it a business entity, business owner, or a high net worth individual family, or even a corporate entity or a practicing professional. So we come across and we stumble upon ODI very often along with FDI. So today being ODI matter, let's kickstart the presentation. And so these are table of contents which we would want to touch upon. ODI by an Indian entity, ODI by registered trust and society, ODI by individuals, and other conditions governing the ODI aspects, disinvestment and restructuring, and procedures and reporting aspects. So jumping into the ODI aspects, so let's briefly touch upon what is ODI all about. So we all know ODI is overseas direct investments, and then which is nothing but an Indian resident or resident entity wanting to or willing to invest outside India. So the regulations, the FEMA regulations govern this ODI transactions, and generally it is structured between listed entity and unlisted entity. So that being the case, in case of unlisted foreign entity, just a minute, let me represent, and I think it got skipped. Yeah, I hope it is visible. Okay, so ODI overseas direct investment, it gets categorized under two activities from the end recipient entity perspective. One is unlisted foreign entity, and another is listed foreign entity. And unlisted foreign entity, it can be an acquisition of equity capital as well as subscription to MOA. In the sense, when we are setting up an entity, we can subscribe as an Indian resident, we can subscribe to the MOA as part of initial equity transaction, or at a later date when we can also acquire from other shareholders by way of a secondary. That is in case of unlisted foreign entity. In case of listed foreign entity, the regulations say that investment in 10% or more of a paid up capital. However, investment with control, even if it is less than 10% of the paid up capital. And overseas investment, once classified as ODI, will remain as ODI. Equity falls below 10% or control is lost. So These are some of the regulations, basic aspects that we wanted to touch upon. And meaning of control. So the control is defined as a right to appoint majority of the directors, right to control management or make policy decisions, and possession of 10% or more voting rights. This is what the control definition under FEMA. Moving on quickly on these basic aspects. Again, the next question arises, what is foreign entity? Foreign entity again has been defined as it has to be formed, registered, and incorporated outside India, that is outside India jurisdiction, and it should have a limited liability. In the sense, it cannot be an unlimited liability entity. So, wherein the liability of the person resident in India who is investing into that foreign entity should be clear and limited. So that means the financial commitment of Indian resident should be clear and limited. So this is the definition of foreign entity. And the common issues that we come across, people would want to predominantly invest into US or UK or European startups or etc. There we have seen the questions that comes up as, what about an investment in S Corp? What about an investment in LLC? Whether we can invest in pass-through entities. These are the questions that comes up, or these are the issues that needs to get addressed. And also a few more questions that we have seen. Nepal and Bhutan, will they qualify as an overseas investment, as the investment happens in rupees, Indian rupees, and not in foreign currency? And there are situations where incorporation already done, but investment amount, the initial investment amount has not been made due to, let's say, this we often see in Dubai-based, Middle East-based companies where the company incorporated, the entity gets incorporated, but the bank account opening happens at a later date. It gets delayed many times because of a lot of regulatory requirements of that country. So how do we address that? In certain countries, we will the investment has to go through special investment account of the individual or the entity investing in entity. So these are all different situations that we come across. I'll answer few and then I'll ask Mr. Kadir also to address. So S Corp, as we say, it is not allowed. The main reason is the US regulations do not allow foreign investments into S Corp. That is very clear. Whereas LLC, it is nothing but limited liability company. There, the investments from a foreign is allowed, foreign entity or a foreign individual is allowed. So these are regulations governed or regulations in place by those countries. So apart from the FEMA regulations that we will have to look through, it is all the more important to look into the regulations of the host country or the country into which we are investing. So Mr. Kadir, I would want to call upon you, and if you can address the next few questions on the Nepal and
Okay,
Bhutan
thanks.
matter.
Yeah, thanks. Yeah, thanks, Arun. So with respect to whether the investment in Nepal, Bhutan qualify as overseas investment, since investment is in rupees. If you see as per the FEMA RBI regulation, if you are making remittance into Nepal and Bhutan, you are not allowed to make remittance in dollar. That is the reason the investment, whatever, if somebody want to establish a company in Nepal or Bhutan, they will have to mandatorily invest in rupees. So what RBI said that even if the investment is made in rupees, since it is a cross-border transaction, that will have to be complied with the rules and regulations prevailing for overseas investment. So the answer is even if the remittance is made in INR to Nepal and Bhutan, whatever the applicable regulations of overseas investment has to be complied with. The next question, incorporation already done, but the investment amount not yet paid due to late account opening. So as per the regulation, if you see in some of the countries wherein shares would be automatically allotted at the time of incorporation, so irrespective of whether the payment is being made or not. In those countries where shares have been allotted, where the payment is being made late, so that would be considered as deferred payment consideration. And accordingly, the individual or entity who wanted to set up a entity in a particular jurisdiction, they will have to approach to the AD banker prior to 1 or 2 days incorporation of the foreign entity and obtain the UIN. This is one of the main requirement to obtain the UIN. So now you obtain the UIN. So that is a time limit within which the individual or the entity is going to make the remittance. For that, you can have an agreement with the overseas entity with the deferred payment agreement that you will going to make the payment within 3 months, 6 months time, etc. So within that time, if the account has been opened, so they are allowed to make the remittance within the timelines which is mentioned in the agreement. This is the correct procedure they wanted to do if some Indian entity or resident individual wanted to do in the jurisdiction where shares should be automatically allotted. Otherwise, if assuming there is a country where the shares should be allotted only post making the remittance, then there won't be any issue even if the incorporation which was already happened, shares were not automatically allotted and shares will be allotted post you are making the remittance, then there won't be any issue at all. Even if there is a delay in opening a bank account, post the account has been opened, the investor can make the remittance from India to obtain the UIN and post which they would be allotting the shares. So there are two scenarios we'll have to see. Depends upon the host country regulation. If shares have been automatically allotted, then it's a different treatment that has to be made. If the host country will allot the shares only post receipt of remittance, then there won't be any issue in making the remittance post opening of an account. And the last one, in case of certain countries, there is a mandate for special investment account. Yeah. So if you see Sri Lanka, example, Sri Lanka, the Indian entity want to invest in a Sri Lankan entity. They are not supposed to make directly payment to the foreign entity. So there was a restriction in Sri Lanka. If any foreign investment coming to that country, it has to be routed through the foreign country investment account only. So that means if assuming ABC Corporation Private Limited in India wanted to invest in XYZ Lanka Limited. So ABC Corporation cannot directly send the money to XYZ Lanka. They will have to open a special investment account in Sri Lanka in the name of ABC Corporation Private Limited. Okay, so they will send the money to their own account in Sri Lanka. From that account only, they can further invest into XYZ. So this is the procedure we'll have to obtain. So earlier for opening such account which requires specific RBI approval, now it is under general permission. So if any entity wanted to invest in Sri Lanka, so they can approach to the AD banker and get the prima facie approval to open an foreign currency account in the name of the entity or individual. And once they get the approval, they are proceed to open an account and make the remittance from India for overseas investment.
Thank you, Mr. Kader. I think it was elaborate enough. I request participants to put their, any kind of questions that they come across in Q&A tab that we have, or in chat group that we have, and we will pick it up towards the end. So moving on, so as we understand, ODI, that is overseas direct investment, we understand it can be made by Indian entities, resident individuals, and entities other than Indian entities and resident individuals, which generally we observe it as registered trust and society. So we will try to address each of these aspects a little bit in detail moving ahead, but we will have a small poll now, and then my colleague will post a poll, and then please answer parallelly, and we'll move ahead. So the first aspect that we will be talking about is ODI by Indian entity. So let's understand what is Indian entity to start with. Under FEMA, for ODI purposes, we have these entities. One is company, a body corporate, incorporated under any law, and LLP and partnership. So company per se, we know it is private, public, and listed entities. All these get categorized under company. A body corporate. Is slides visible?
Now,
But it is not changing, Ramesh.
Okay.
It is in the earlier earlier screen only.
Let me represent.
Arun, you want me to present it and you toggle it? Slides? Am I audible?
Yeah, we can hear you.
Yeah. Oh, okay, perfect. You're able to view the slides as well?
Yeah.
Yeah.
Okay. One second. I'll just wait for Arun to join. Otherwise, I'll take this forward. Considering the time, I will probably take it forward. If Arun joins, then let him take it forward. So typically, when you say investment by a company, the corporate form requires you in predominantly two. What is defined as Indian entity for making the ODI has been specified under the regulation. One, it says it has to be either a company or it can be a LLP, or other alternative that has been provided is in the case of a registered partnership firm. Now, when you the one of the main criteria that would come in as part of ODI is how much is it that you can actually invest. That is one of the key criteria that can be considered. Generally, the requirement is that there will the what we call as a financial commitment. What is a financial commitment is the money that you can actually invest overseas, either in the form of an equity capital debt, or it can be even any non-fund based facilities that can be provided. What has been provided under the regulation is 400% of your net worth, and the manner of computation of the net worth is also provided under the regulations. So when you say a net worth, the calculation is specified where it says paid up capital reserves, premium, and if you have any accumulated losses that you will have to consider and reduce it in computation of net worth. Very often this question comes up in case of a lot of startup enterprises where they say that they also want to have a entity which has to be set up overseas. But one of the as professionals where we need to start in terms of computation is the balance sheet, which is the last audited balance sheet. If the audited balance sheet has a case of capital and net of losses, you don't have a number there, then any time multiplied by that number is going to give you only a zero or a negative number. So you actually can't make an investment. So generally we say that when you have any entity which is newly set up, please have a look at what is your net worth in terms of capital brought in or in terms of whatever is your reserves that is available. If you have reserves only, you can have a net worth for investment overseas. So this is something that we need to be kept in mind. And another question is the requirement is on the last audited balance sheet. Very typically, we usually take it as the last available provisional financials, but the requirement under the law is the last audited balance sheet. So requirement of an audit is quite essential in terms of having this computing this limit. Now, this when you have to extend the same concept to a partnership or an LLP, it works similar manner. Only that in case of companies, you have reserves, but you have undistributed profits or distributed profits. Now, whatever is the profit, you need to determine, and the logic set in terms of what is net worth calculation can be done. Now, when do you actually compute this concept of threshold limit? The threshold limit will have to be considered at every time you need to make a financial commitment. That is, you make an investment. At that point in time, you will have to consider the threshold limit of 400% of your net worth. Mr. Kadir, if you can just throw light on this. We are of the opinion generally that if you don't have, say that you are trying to make a remittance sometime in July or August, and our last audited is not completed by the time, what we have is the previous year audited. There is also another requirement which says that it has to be minimum 18 months is the time period for the audited financials to be done. Then would that mean that even if I want to make an investment today, can I cut the financials, say at June, make a proper closing, have an audited number? Can it be used for making an investment? Would that be permissible?
Yes, absolutely. Because the provision says that the maximum period of the auditor cannot exceed more than 18 months. So as per the assuming in the month of March 2025, client is having negative net worth. Okay, so at the time of making remittance in the month of April, he is not allowed to make the remittance since net worth is negative. Now in the month of June, as per your example, they become positive net worth. So they can very well do the audit for the period of 30th June, and they are allowed to make it positive net worth, and they are allowed to make remittance in the month of July. The regulation says what is the latest audited balance sheet. If you come to see in the month of July, the latest audited balance sheet is not March 25, is June 2025. So we'll have to go by June 2025, and if it is positive net worth, then they can remit up to 400% of their net worth. Yes, they can audit any point of time, they can audit. The only thing is the financials should be audited one. That is the criteria which we will have to use. Not mandatory on the yearly audit. Any interim audit, any type of audit they can do. But the only thing that the net worth should be as per the audited balance sheet.
And one of the other requirements is that you can't make an arbitrarily make an investment through debt alone. You also need to have equity investment in that entity before you actually provide any amount in the form of debt. That is also a requirement, isn't it?
Yeah, correct. Because one of the main important thing to consider is before giving a debt, the equity should have been already made to the foreign entity. And not only that, the criteria, they should have control on that foreign entity. Control means they should have done minimum 10% equity in the foreign entity. Then only they are allowed to invest by way of loan. For an example, if an entity has invested only 5% equity, then they are not allowed to make further loan if they don't have the control. So the control also should have been there. And the second is the first investment should always be equity, post which only they are allowed to make by way of debt or by way of giving non-fund based by guarantee or SPLC, etc.
Understood. Thank you. So this is one thing that we need to consider. So what we have done in past cases also, we have recommended that if there is a negative net worth, how can we consider it to be positive before you make that investment? So another one more aspect that has come as a relief through the new overseas regulation, I couldn't call it new, but it is sort of new because it is 22, is that the whole aura or question that has happened around round tripping. Now, whether with the new requirements where people are also considering investment, creating a funding requirement or raising funds overseas, there is always a requirement whether can I do a round tripping structure. So earlier regulations, what had happened was this entire regulation requirement with regard to round tripping was completely prohibited. As a welcome change and the requirement for ease of business, the government enabled the concept of a round tripping. Now, the only requirement that has come out as part of the structure, which is also in line with our Corporate Companies Act, is the requirement that when you have a round trip, when you have a structure where the investment is happening into India, you need to have a two-layer subsidiary structure that needs to be in place. Now, there has always been a lot of debating that happened where they considered whether this two-layer of subsidiaries, where do you compute it from? The general viewpoint that has been taken as a consensus is that you take the two-level subsidiary level from the foreign entity to determine this investment. So this is one of the enabling provisions that has happened through the ODI regulation. Now, there are exemptions also where this two-layer ODI restriction has been removed, which is in the case of banking companies, NBFCs, or insurance companies, where we have seen that it's been a relaxation in terms of the provision for this two-layer ODI structure. Now, one more concept that is actually a lot that has been discussed now is whether you can have trust or society which can actually do an ODI. Now, apart from a resident individual and an Indian entity, a trust or an society is also allowed to make an ODI. Now, this actually makes us very happy because today we have a lot of people actually trying to consider the concept of a private trust. But there is something where the whole thing is sort of put to a pause there, because what is allowed under the ODI regulations is only in case of registered trust which are engaged in education and who has set up hospital in India. So in most cases, having private trust is a mechanism that has been considered in the current economy. But a requirement of investment through a private trust is possibly a no-show. We will have to sort of work around other structures possibly in order to enable this kind of investment. But typically, education and hospital is what is allowed, and any other form of business is not allowed through this particular setup. So this is with regard to trust and society. Now, the major aspect where we always have a stumbling block or the most sort of a query area that we have is in the case of ODI in case of resident. Now, when you say resident, individuals can also make a investment into an overseas entity. Now, we do not, as individuals, we do not have the benefit of having a 400% of your net worth. The requirement that comes up is our LRS cap that has been provided to us, which is USD $250,000, which is an annual limit that has been provided. So as individuals or as any high net worth individual, we need to be careful in how we navigate this overall limit of USD 250,000. Now, often the sort of questions that come up to us is that we are only an individual, we are going to pick up a very minority stake in a foreign entity. Do we still need to go through this hassles of what you call valuation, providing regulations of Form FC, etc., etc. Now, the interesting part to note is that in the erstwhile ODI regulations prior to 22, there was sort of a gray area where we don't know whether it was classified as a whether it was classified as an ODI or not. There were a lot of instances we have seen in the past where they say if the threshold, most of the banks took it on each of their note, where they say if it is less than a 5% or a 10% threshold, they had defined it as OPI and used to make the investment. But the whole thing has been made very stringent under the current ODI regulations, where they say even if you're going to put $10,000 into an entity which is overseas, you need to comply with the ODI requirement. When you say ODI requirement, you need to have a Form FC filed for that particular investor. You need to ensure that particular entity has a UIN allotted. If you're not subscribing to the shares of that entity, if you're making an investment, you need to have a valuation report which needs to go along with the requirement. This has been sort of made a mandatory requirement irrespective of what is the stake that has to be acquired by the individual. Now, when you have individual ODI that has been made, one of the other requirements that you have is for us to make a logic check from an investment side whether that particular entity is a bona fide operating entity. Now, what is the restriction that has come specifically for individuals is that you cannot have an entity which is just like a holding entity. That particular entity need to necessarily be an operating foreign entity. And the other requirement is that they should not have any, if the particular individual is got control over the entity, you cannot have a subsidiary or a step down subsidiary under it. These are the two requirements that has actually come up around that. Another requirement is that it should not be engaged in financial services. Now, the important thing to be known is that whether control exists by that individual. Now, normally when we say control, we always have this bias where we say if you have majority holding in that entity, then automatically control comes. But that is not the requirement. The law clearly defines what a control, and where you say if you have 10% stake which is acquired in that particular entity itself, automatically that is sort of a control that you have. Hence, you cannot say that you have less than if you have more than 10%, say you have a 15% interest in that particular foreign entity, you cannot have a drop down subsidiary for that particular entity. So this is one of the requirement. Now, Mr. Kader, this is one more question that we already usually have as part of any of the requirement is with regard this safe note. Safe note has been provided as a beautiful thing, which is a simple agreement as the name of safe itself goes. And it says you can convert it into equity based on a future funding round. Now, as part of regulations, though it is an enabler in an overseas host jurisdiction, the question, everybody says that why do we have to have a valuation certificate provided today? Because it is a future converted equity. Can you actually sort of throw an idea in terms of AD bankers? What is the requirement with regard to SAFE?
Yeah. With regards to safe instrument, first of all, let me clear that safe note which will not be considered as an equity instrument. So there is a provision which is given in the OI rules and regulation. Instrument which is mandatorily convertible into equity will be considered as equity instrument or equity capital of the foreign entity. But unfortunately, as of now, the AD banks, majority of the AD banks would be considering equity instrument as equity compulsorily convertible preference shares and compulsorily convertible debenture, which is at par with as per the Companies Act regulation. If Indian investor who is investing any of this instrument, then only we would be considering as an equity capital. There are a lot of representation came from various people that they wanted to invest because the safe note is the one of the main instrument in US. So they wanted to invest in safe note, but we have got unofficial confirmation from RBI that SAFE will not be considered as an equity instrument when under OA rules and regulation. With respect to CCPS and CCDs, which would be considered as an equity instrument, why we do need to obtain the valuation at the time of subscription to CCPS itself is that similar to FDI. In FDI case, if some investor who wanted to invest in Indian company CCPS and the pricing guidelines should be complied with the equity, with the valuation of the equity shares. So on the similar lines, though the regulation is silent about the valuation, it's not silent. They're given the delegation power to each of the individual bank to decide as per their board approved policy. So the banks are insisting as per the methodology which we are adopting for FDI, the same methodology we were adopting when we are making when individual or companies investing into CCPS or CCDs of the foreign company. Because though they are subscribing to CCPS, so that would be considered as an equity capital on fully diluted basis. So we would be taking the valuation of the foreign entity of the equity capital, then determining accordingly the shares would be issued at the time of conversion should not be more than the price which is being done at the time of allotment of CCPS.
So practically, Mr. Kader, if I can ask one add-on question to that, say for example, I'm making a safe investment today and there is a certain valuation that is available for the company. Now I give that as a, I say that, okay, it is a convertible instrument I put and I've given a threshold valuation today. Say another 1 or 2 years later, there is another funding round that happens in the overseas entity and they give me at a discount to the earlier at the valuation price prevailing at that time. Now, the fact remains that today I have provided a form FC where I have said this is my diluted equity and this is the number of shares I'm going to get. Say, for example, after a year and a half, I get number of shares which is actually lesser. Would there be any requirement where I need to go back and communicate to the RBI? What would be the sort of stand that would be taken? Should I disregard the valuation provided initially? And can I take a conversion ratio subsequently? What would be the requirement practically?
So coming back to your question again in FDI, so we'll have to compare with the FDI wherever this kind of convertible instrument. Okay, in FDI it was pricing guidelines was very clearly given that there is a CA certificate and whatever be the price you can allot, which should be more than the price certified by CA. You cannot allot less than the price certified by CA. So there is a guidelines which were very clear that how much above you can put whatever be the amount above you wanted to put, you can put over the CA certified value. But if you see OI rules and regulation, whatever the price which has been mentioned, the remittance has to be made that price only. It can't be made more, it can't be paid less.
Less.
Okay. So it should be as per the arm length basis, which is duly certified by the chartered accountant. So that relaxation of less or more, which has not been clearly given in OI rules. So if you go by that, no, so even at the time of conversion, if they are going to allot less number of shares, then it is not as per the rules which is given for OI rules. So that is the reason only we are insisting that it has to be as per the pricing guidelines when they are investing initial time, because they invested now and now they have allotted the shares. That means now they are allotted the CCPS, which is considered as a fully diluted basis of equity shares only, irrespective of whether the conversion, whether they are getting less number of shares. Ideally, they should have got whatever the price which is invested now. So to that much amount, they should get the number of shares.
Okay, so it is sort of inflexible. So that is why in form FC, they actually provide you a mechanism where you say pre-investment, post-investment, number of shares and fully diluted basis, so that the number is sort of etched at the time the transaction has happened itself. Understood.
True.
So as I said, with regard to control, now control is possession of 10% or more of the voting rights. Now, this is a very interesting thing that generally happens is what is that even though we have had past experience where prior to 22 we have had multiple investments that has been made by individual, and the banks were a little lax in terms of categorizing it properly and requirement of ODI or form ODI to be furnished. The resulting impact of that has happened now is that post 22 rules that has happened, if you want to make any disinvestment or if you want to make any share transfer that has happened, if you have made an investment overseas and you have not generated UIN, what the issue that has happened is you cannot make the disinvestment or make a share transfer unless a UIN is mandatorily generated for this particular transaction. So this is now, we are seeing it in the last 2 years. We have seen in multiple cases where because of the laxity of the bank in the previous case, now we have to undergo the entire requirement of regularization that needs to happen. Mr. Kadir, one question that I have and a lot of people ask is because when you do an ODI from a company generally, we sort of are tied to a particular bank as the AD banker. Now, in a resident investment that has happened, only post over this 22 regulations that you have that tie-up with regard to UIN can be created by that particular AD banker. Now, if you have had made investment previously, which should have been covered under ODI, and you need to regularize it, is there any mechanism possible? Can I move away from that particular banker and do the regularization through any other bank? Is that practically allowed?
So with respect to whether it is a company or individual, as per the rules, any remittance which has been made to the foreign entity, it has to be routed through that bank only. All future transaction, irrespective of whether they have obtained UAN or not. In your case, in some of the cases where some of the banks may allow, because of the prior 22 regulations, if somebody is holding 5%, 7%, 3%, they would have made the remittances under LRS scheme without obtaining UIN. So now post 22, the definition which was very clearly given that if some individual who wanted to invest even less than 1% towards subscription to MOA or towards unlisted company share, that will be considered as an ODA, and respective forms needs to be filed to obtain the UIN. So there is a provision which has been given in OI rules. There is a timeline they given for 3 years to regularize all the non-compliances. So which is going to complete before 22nd August 2025. There is hardly another 2 more months is there. So if at all, if any individual or any entity who has made the remittance or not obtained the UIN, now they can approach to that AD banker and regularize these filings and file the required document and obtain the UIN to regularize the filing. So this is the very good opportunity which is given to clients who has not done the earlier regularization, non-compliance, etc. So they can go and simply make the payment of LSF hardly 7,500. It's a minimum one. So maximum will go up to 10,000. That depends upon the amount. So at least they can go and regularize and sort out the non-compliances so that in case if they wanted to disinvest, they can post disinvest after the UIN obtained. So it has to be made through that particular bank only where the remittance has been effected.
So, Mr. Kader, I'm privy to this limit of August that they have provided. But is there a mechanism or of a fast track mode or something that has been provided? Because for me, the approach area for any of these transactions is through the AD banker. And typically, when I make an application for regularization, it takes anywhere from 3 to 6 months or sometimes even 9 months to get this job done. So, how is it feasible for this to happen by August?
I don't think so. I don't know why it is taking 3 months, 6 months down the line. Even we have seen a number of cases wherein as and when the documents are available with them, simply we can report it and it will go for LSF and RBI. It's an online, it's not physical application which we are submitting to RBI to get it approved by them. This is an online portal. Once all the documents are available, then we will report the transaction and we will, because of the delay in reporting, the system will automatically sends out the mail to the client. You have done this non-compliance, you will have to make the LSF payment of this much. So this mechanism, which is easily we can able to close within a week or maximum 2 weeks time to regularize all the non-compliance. The only requirement is that they should have all set of documents to the AD bank to get the UIN. So it hardly will take a minimum 7 days to 10 days only.
Okay, perfect. So I'll go forward with regard to this subsidiary structure. So one of the other main things that has to be noted, as I mentioned previously, is with regard to this prohibited subsidiary structure. If you have an individual who is directly making an investment, you cannot have an SDS under it. So that is one of the requirement. The only place where this particular structure has been done away with is that if you have acquired this particular foreign entity shares through an inheritance, then this exemption is provided. Or in a circumstance where you have obtained this particular shares in the foreign entity through ESOP or any qualification shares, this particular requirement of SDS has been done away with. So that is the exemption that has been provided. Now, often there is a lot of question around whether there is a workaround in this kind of structure that is available. The only way that you can have a workaround for this structure as an individual, you cannot have. If at all, you have to think of having an organized corporate form, and also that corporate form will have to necessarily be in a business. And then you can think of having a structure where you can have an SDS form of a structure because you will fall under the requirement of a corporate and an Indian entity, and those regulations will actually apply to you. So this we need to keep it in mind when you have when you have this requirement. Now, what is classified as ODI has been in multivarious. The common ones that we know is through subscribing to the shares of an entity. The other mechanism in which a particular transaction can also be categorized as an ODI is that if there is right or bonus allotment, or if you have got a gift or an inheritance, or even if you have an ESOP or sweat equity that you need to subscribe to. Now, one of the important things that you need to note is that if you have advisory shares, which is actually coming free of cost, provided to you from an entity overseas, you cannot classify that as any of these items because it would be a sort of a prohibited transaction, because you would have not made a form FC and there is shares actually directly coming to your name. The other mechanism is that if you still have to take an advisory share, if you have to subscribe to that amount and make a remittance of the amount overseas, that would go through your regular LRS requirement and you can acquire that particular share. But still your compliance with regard to whatever is your valuation, etc., will also have to come into play in that requirement. So this is overall left. I just want
Maithili,
to
we have a poll coming in.
yes.
So request the participants to address it. Parallel, you can continue, Maithili. You can go ahead.
Okay, so one aspect is with regard to gift and inheritance. So common cases that we have is an inheritance. If you have to acquire any shares through an inheritance, there is no particular restrictions under the law. You can jolly well go ahead and inherit the share, and there is no requirement for whether it is a prohibitive or anything is not, it doesn't happen. So only thing that we need to keep in mind is that if you are actually taking a gift, if you're getting any of these foreign investments through a gift mode of a gift, then you will have to keep in mind what is the gift regulations that comes into play. One is an FCRA is one of the driving regulations which provide visibility on this. You need to make necessarily if it is a relative. If it is less than a 10 lakh requirement, there is no requirement. If it is anything more than 10 lakh, then you have to file the necessary forms under the FCRA regulation. There is a form FC1 that you need to provide. If it is a non-relative, then you need to be very careful. If you have a non-resident who is going to give anything to a gift, then it is prohibited under the regulation. So this is something that we need to keep in mind with regard to the gifting route that happens generally. So, Mr. Kadev, one more question. This interplay of requirement, which is your gift with FCRA and FEMA. Now, where does this entire reporting stream actually go and sit? Because it is just a mere RBI requirement. And is that actually something which is looked into, and what is actually prohibited under that particular requirement?
Okay, so one of the yeah, when they are receiving gift from non-resident, so it is a foreign contribution regulatory act because they are receiving the value of shares as a free. Okay, so if you see any donation or anything which is comes from outside India, that has to be in compliance with FCRA regulation. Since this is one of the mode which, though they are not receiving fund, they are indirectly they are receiving equity shares of the foreign entity into an Indian resident individual. So that is the reason they wanted to match it up with this particular FCRA regulation. But what I understand, when FCRA regulations allowing a person resident in India to receive contribution up to INR 1 lakh. Okay. So if the value is INR 1 lakh, if the value of shares is less than INR 1 lakh, then there is no, they are in compliance with the FCRA regulation. If the gift value is more than INR 1 lakh, then they will have to necessarily seek MCA approval before receiving such gift by the resident individual. So is the clear cut thing? If the value, you will have to see the face value only normally. See, because normally at the time of incorporation itself, they would be post couple of months incorporation, normally this individual is getting by way of gift from non-resident relative. That point of time, we'll have to see what is the value of the gift only at the time of receipt of shares by the resident individual. What is the value? Then we'll have to calculate what is the rate exchange for that value. Then to compute, if it is less than 1 lakh, then it is fine. If it is more than, then they'll have to get NCA approval.
Is there a different threshold that is available in the FCRA which is separate from FEMA? Because I came across a requirement which is roughly around 10 lakh is what I remember seeing.
No, because one of the case we represented actual case with Reserve Bank of India. Then we came to know, and our compliance team has gone through the FCRA rules and regulation, and they confirmed us that INR 1 lakh. Earlier it was
1 lakh.
INR 25,000 or 50,000 something. That cost increased to INR 1 lakh. So now
1 lakh.
we'll have to see values INR 1 lakh.
Okay, fair enough. So one more thing that we often come across is that of an ODI ESOP. Now, truly global companies that we work for, we have a lot of people working in India who are actually getting securities from overseas. Now, the one of the criterion that is requirement is that even though you are actually getting securities worth whatever it is and you have to subscribe through, there is always a requirement of LRS limit, which is actually hanging with regard to compliance. So you cannot do anything which is in excess of 250,000. If you want to make any subscription for those kind of shares which is in excess, you have to go through the RBI approval route. Now, there's an interesting part which generally happens is that in case if you have to have an ESOP, there are two aspects that is covered under the master directions that has been provided. One is that if you have an where you actually subscribe to ESOP which is not exceeding 10%, then it gets categorized as an OPI. But if you're having something which is in excess of 10%, then it gets categorized as an ODI. Now the differentiation arises only in this regard, that the headache of any sort of compliance that needs to be done with regard to an OPI happens through the employer, who needs to file a form OPI, and the reporting has to happen every 6 months. And whereas in case of an ODI, you need to make a form FC. Those are the two things that typically happens now. Now, one of the things that happens is that the pain point that is generally seen as part of these regulations is that this is even though that particular employee doesn't continue in the employ of this entity and has moved on also, and if there are certain shares that he is subscribing to it, the onus is on the employer in order to keep stock of number of shares and what has been vested, what has been subscribed, etc., and make the reporting. So this is sort of a nuisance that, in my opinion, is an absolute nuisance, because as it is, company having track of its own data is tough. Now it also has to keep a track of the overseas holding entities portfolio and keep liaising and keep this reporting in place. Now, one of the common questions that we have is that, is there a requirement for valuation? Can you throw light on this, Mr. Kader, with regard to valuation, with regard to OPI or ODI in case of an ESOP scenario?
Okay, and coming back to ESOP, if you see the ESOP itself, it is defined employee stock option scheme. Normally, the price would be offered, which would be discounted to the employees with certain conditions. So since it is already given as a discounted value to the employees, there is no requirement for obtaining valuation certificate when somebody is investing under the ESOP scheme. Second question, which you have talk about the employer, how the employer will know when the employee himself is making the remittance through their banker, which they are normally remittance. So there are two ways this ESOP remittance will be made. One is the employer themselves will deduct a certain portion of the money from the salary of the employee, and they would be making the remittance on behalf of the employee by giving the details of the employees. That is one way they can remit. Second way is employee themselves approach to the lady banker and to make the remittance from their savings account. There only the challenges would be there for the Indian employer. Okay. So what we would be giving is, that is one of the documents, since it is the responsibility of the Indian company to file form OPA on an half-yearly basis. So at the time of making remittance, that point of time itself, we are obtaining a declaration from the employer stating that we would be reporting a fairly form OPA within 60 days from the date of closure. So any employee who want to make the remittance through a particular AD bank, he needs to obtain a letter from their employer so that the employer is well aware that this guy is going to make the remittance to that banker, and accordingly they are in a position to report in an half-yearly OPA reporting post remittance is being done. So this way we are ensuring that Indian company is well aware of the payment which is being remitted by employee. I'm not sure about other banks how they are taking, whether they are taking such declaration or not. If they are not taking such declaration, as you rightly pointed out, it will be very difficult for the Indian company to report that transaction. In our bank, we are putting that control so that it will be easy for Indian employer as well to ensure they would be correct, reporting the correct position. And second thing is this ESOP. Normally, if you see the ESOP, there are certain conditions attached to that, that there should be some shareholding should be there with the foreign entity, should have holding in the Indian entity, and this scheme should be offered on uniform basis, etc.
Correct.
If an employee himself is going and approaching to their AD banker, okay, then the AD banker may not know what is the relation between this employer, this
And
employee company. Okay, so whether this ESOP remittance itself is compliant with the regulation. So all these conditions, declaration we would be getting from the Indian companies to ensure that one is we are ensuring FEMA compliance at the time of making remittance. Second, we are ensuring that proper reporting would be made by the company post remittance is being made.
So typically what we see is that under the Indian law with regard to ESOP, you generally have a threshold limit where they say a founder person cannot hold so much, etc. But when the interesting part of the wordings of the regulation says that there is no limit, it is without limit. Now that presupposes that you can also have an ESOP which is in excess of 10%. Now the challenge comes because I have to furnish a form ODI instead of an OPI for those transactions. Now an ODI is actually through for a subscription for an ESOP, which is actually being made available to me at a discounted price. In that case also, is there a common guideline between banks that it does away with all the valuation norms, or does it insist on the valuation?
Depends on bank to bank, because the pricing guidelines, which is not specifically given by Reserve Bank of India, that authority delegation power they given to the banks to frame up to their board approved policy. As I said in the beginning, that depends upon bank to bank. If a particular bank is incorporating for ESOP, the valuation is not required. Then definitely if that bank is undertaking a transaction, they would not be asking valuation certificate. If some banks which is not given an exception to ESOP, then they would be obtaining valuation certificate, because as per their board approved policy doesn't allow them to make their remittance without valuation. So regulation, since regulation has given delegation power to the AD bank, so each bank will become an HRBA. So whichever banks, both are right only. If I am not including in my board approved policy, I cannot allow. So I myself is correct. Similarly, when some banks is including, so they are also correct. So that depends on case to case basis and bank to bank, that might differ. So there is no uniform guidelines which has been given by Reserve Bank of India. As you rightly said, we discussed that since ESOP is a discounted value, I don't think the valuation is required. Otherwise, there is no point in subscribing at the current valuation.
Correct. So I will sort of touch upon the other restrictions which has been provided as part of the ODI regulations. One is that a real estate activity is generally considered as a no-no. Gambling, of course, it's not legalized in India. So even if somebody wants to try doing that overseas also, it is going to have face a roadblock there. Now, these are the two main areas. One of the common questions that generally come up as part of our advisory requirement is that can I have an entity, and can that entity go and have a buy a property? Because it is an entity you're going to make an investment into, can you have that entity not having a bona fide business? Now, general response to this particular requirement is that as we revisited the ODI requirement, if it is by a resident, it needs to be on a bona fide activity, and you cannot have real estate. If real estate is just mean you're going to buy some asset and then sell some asset, then it is a no-show there. But if you are actually involved in a bona fide activity of construction, or you're having getting into projects, and as a result of which you have acquired certain units which you're going to hold it as an inventory, or if you have some inventory which is converted as asset and you're holding it for leasing, then it is an allowable activity. I think there we have an absolute clarity. This clarity was lacking erstwhile regulations, but in the current regulations, the clarity has been provided. So one more thing is that with regard to ODI, just like how we have a startup ecosystem, if you have a startup ecosystem overseas, when you have to make an investment into such startup, how do you make a investment? That is one of the requirement. Now, the mandate that has been provided by the RBI in this regard is that you can make an investment into such startups, but that investment can be made either from your capital contribution, or you have to have internal accruals based on which you can actually make that investment. There is a no-show in terms of trying to borrow some money and make an investment into an entity which is a startup. The reason is that the entire ecosystem has been built in order to preserve the money that is there in India. And there is a judicious requirement with regard to valuation and what is the potential of each startup. And if you don't have money, you cannot go and decide to borrow the money and splurge the money overseas. So that is sort of a requirement that has been provided as with regard to the startup ecosystem. Mind you, this is startup from an overseas investment perspective and not an Indian startup. An Indian startup will still fall within the requirement of corporate making an ODI, where you need to have positive net worth for you to make any sort of investment overseas. And the other thing is with regard to financial services activity. Now, with respect to financial services activity, you can invest, an Indian entity can invest into a foreign financial services, providing you have net profit in the last 3 financial years. That is one of the mandate, because this is why it is actually regulated in such a fashion, is because we are all under regulations of the respective financial service authority in India. Hence, it is important to have such approvals and such availability of net profit for you to make an investment. One of the important things that is to be noticed with regard to financial service entity is that how do you categorize an entity in which you're making an investment as a financial service entity? Surprisingly, the call has been happened with regard to if that entity has been functioning in India, and it would, if under those circumstances, it would be regulated by the Indian laws, then that's when you categorize the particular entity as a financial service entity. Hence, the requirement is not from the overseas host jurisdiction that comes up. It is that if you run a similar business in India, if you're going to be regulated, then it gets classified as financial service entity. So that is one. And we have an exemption with regard to COVID. I think that COVID exemption is now the 3-year, we are going past it. Probably next year, it will not even be applicable. Now, this is one important aspect with regard to pricing guideline. In case of the FDI, there is always a requirement where it gives a threshold limit, and it says that the value has to be something more than that. You can't give something which is lesser. But the erstwhile ODI regulation, what was there and what it is today, there is a change in terms of what is the valuation requirement. The valuation has been provided as arm's length basis and based on an international accepted methodology. And there is also no specific guideline which has been called out in the regulation saying who can provide the valuation report. What we have seen in the past with regard to all the AD bankers is that based on comfort, when we talk to them one-on-one in terms before we make the remittance, asking them for a valuation report, they say we have seen them extensively depend on an erstwhile guideline which was there in ODI regulations, and they say that either you have to have a threshold of less than 5 million, you can do a merchant banker or a chartered accountant, or if it is more than 5 million, you can do it through a merchant banker, and there is no CA. Does this have a uniform requirement across all banking, Mr. Kader? This is something which is I'm always curious about, because when they interpret law, it is always the convenience of a previous regulation. It's like somebody decided not to use that regulation or put in effect that valuation requirement there.
Absolutely. Again, Same thing. This since pricing guidelines is given to the independent AD bank to decide on their own. Okay, most of the banks have stick to the earlier regulation up to 5 million chartered accountant, above 5 million category 1 merchant banker. So that they are safe. Though it has the delegation power given to the AD banker, they don't want to uh, amend it to their comfort. So whatever is the existing regulation, they are continue to do that. Most of the banks I've seen that the valuation remains same. S12 as per the S12 FEMA 120. The time limit for valuation report, again, it is depends upon the individual bank to bank. But normally banks are taking what is the timelines which is given for FDA. The same 3 months time they are taken for ODA as well. So if any person who wanted to invest in a foreign entity, that foreign entity valuation has to be done not more than 3 months prior to the remittance. So most of the banks is safer side for them to keep it as to synchronize with the FDA policy. So they are keeping that timelines for ODA regulation as well.
So one more thing that comes up is that okay, sorry, I missed my train
No
of
worries,
thought.
Maithili. We have a poll now, and
Yeah.
I think if I look at the time, it's 4:15. What my request is, let's run through the rest of the slides,
Yeah.
and then we will take up the Q&A. The session may get extended by another 15 minutes because we have quite a lot of questions that are there. We will try and address all those questions.
So one aspect I will cover only on the disinvestment side because we have very interesting questions coming up. The rest of it is compliance because if you don't do something, what is the way available under the law? With regard to disinvestments, what we generally have is that you have a complete disinvestment, and the normal question it is gets asked as part of specifically resident investment that happens is, can we use the money and rotate it for further investment overseas? The whole anomaly comes up because under LRS regulation, it says that any interest or what do you call dividend, anything that has been earned, if it is not, if it is, it can be reinvested back. If it is not reinvested, then the requirement of bringing back to India is a mandate. Now, the question is whether a profit on a sale of an investment, which is a disinvestment that is happening, can it be considered as an income and can it be used for reinvestment? Now, our thought process and the way we advise is that there is an overall threshold that is available for LRS, which says that you should have 250,000 US dollars per annum. Now, if you're going to make an exorbitant amount of money overseas and the money doesn't come back to India and it gets reinvested overseas, there is no way there is a mechanism for the Indian law or RBI to have control over your assets. Hence, the requirement is that the money has to come back to India and then you can further make an investment overseas subject to your LRS limit. Mr. Kader, if you can give your take on this aspect alone.
So two way of making investment. One is under ODA regulation. If somebody is investing in an unlisted entity, apart from LRS is the only limit wherein all the provisions of ODA regulations have to be complied with. So as per the ODA regulation, if you see the disinvestment proceeds has to be received within India, within 30 days from the date of disinvestment, and they'll have to file the respective form FCG Part G or Part F. So there is a specific requirement when individual is making the remittance under LRS to invest in a foreign entity. If they have made the remittance under the ODA, the remittance has to come back to India. Whatever the profit which has to come back to India, whatever interest, it can't be interest, whatever dividend which is required, it has to come back to India. In case if the remittance is being made through ODA. In case if they are making the remittance through LRS under OPA, okay. So there is no follow-up, there is no mechanism whether the money has to be received back or not. So those funds, if they are receiving, because they are allowed to open a foreign currency account outside India to route all their LRS transaction. So they can keep the money over there, they can realize, further they can invest. If they don't invest within 180 days, that money has to be refunded back, repatriated back That is for all other investment type. But if they have made investment under Form FC, under ODA regulation, that has to be necessarily come back to India to report it under Form FC, disinvestment.
Okay. And the other thing that usually happens is part of the deferred payment arrangement. If you have made an ODI and you want to get the money back, the mechanism that has been provided under the law is that you can defer the particular consideration. That is, it can come in tranches. It doesn't need to come immediately. Now, surprisingly, when they actually provided this deferred consideration requirement, it had not provided an outer limit in terms of how long this consideration can actually go. Would that mean that this deferred consideration can happen over a period of 3 years? Or is there a certain requirement under the law which the bankers actually have taken a position where they say a deferred consideration cannot be beyond 2 years in terms of number of tranches, etc.?
There is no specific regulation which providing them to restrict, you can go up to 2 years, 3 years, etc. Unlike in FDI. In FDI, it's very clearly given that deferred cannot be more than 18 months from the date of effective transfer. But here the regulation is very clearly given that they can decide among between them how much they want to defer and how long they can defer. So there is no specific timelines which ED can put on them to complete. So any number of tranches, any number of time limit. There is no specific time limit for both investment as well as disinvestment. The only criteria is the share should have been transferred first.
Understood. So this is with regard to balance sheet restructuring, and I see very few cases of balance sheet restructuring that actually happens unless somebody decides to clean an overseas entity's balance sheet. The only requirement is that you can't have your cleanup alone and not clean up the overseas balance sheet. It has to be in tandem. And if that is required and you've decided to write off a few losses and do aspects like that, then please get an RV. The only place where an registered valuer is mentioned as part of any dynamics as part of ODI regulations is in this aspect where there is a requirement for restructuring a balance sheet. Now, this is with regard to procedures. I have actually touched upon the major aspects. I will have a quick run through is with regard to the UIN. One of the important things that needs to be noted is that any investment that happens and which is actually happening now as part of the banking system is that money doesn't go out of India that easily. Though I've seen a lot of banks actually promise that it happens in 3 days, 4 days, 5 days. It is still yet to be in a dream state. And it generally takes a longer time. The reason why that happens is because of this UIN requirement. There is a requirement of a UIN for a foreign investment that has to happen, and it needs to be backed with the valuation report unless there is subscription to your memorandum. It's a new entity. But even if it is there, if it is a 10 rupee or a $1, a point not $1, you still need to have something called as a valuation report and a UIN. Without that, the transaction doesn't go through at all. So this is with regard to, I'll just quickly check upon these APRs. An APR and FLAs are one of the important requirements which we need to comply with apart from the Form FC when we make an investment. In an APR, generally what happens is that it's every person who needs to make an investment, whether it is a resident, whoever it is, generally has to make a filing of APR by December. The laxity that has been provided for a couple of investments is that you have a set of investors, like 5-6 investors who's making an APR. The general Bakra has to be the one who is investing the most. They have to file the APR and the rest of them can follow suit with him. Generally, banks I've seen take a declaration saying that so-and-so will be filing the APR for future years as well, because there are multiple investors who are actually investing into the particular entity. But nevertheless, it's a regulation. It is a form you need to file as well, comply with it like an income tax return and be done with it. Other aspect is with regard to FLA returns. An FLA return, generally, there's a time limit is just around the corner and another 15 days, the deadline is there. It is required by any corporate entity who has made an investment overseas or received an investment. You need to furnish your foreign assets and foreign liabilities, and this needs to be furnished on an annual basis. So this is with regard to FLA. Now, Arun, I'll let you take over, and I think I sort of come to a conclusion with regard. I hope I have touched upon important aspects. Anything else, please add on.
Yeah, thanks, Maithili. So I request you to manage the slides, continue to manage it. So there is a poll, request the participants to participate in the poll. Meantime, we just wanted to list out what are the various activities that as a professional we can provide as part of our service offering. So we could list out all these things. One is cross-border structuring support, facilitation for ODI. Cross-border ESOPs is a big thing because today Indian companies which are subsidiaries of foreign entities, they go through this ESOP process. Of course, regularization of ODI transactions is another thing where we come across generally where entities want to look for expansion overseas, and these are the areas which they uh, forget to comply with. And then valuation services for ODI as well as FDI. Of course, there are quite a bit of situations we come across where drafting is required. It can be, for example, a deferment of payment agreement for share transfers, etc. And of course, licensing with AD bankers. So we have tried to holistically look at what are all the services as a professional that any professional can offer. So this is one thing. So next slide, Maithili. Of course, we have listed a few of our upcoming webinars on these spaces, business succession, FEMA, FDI regulations. Under FEMA itself, we have not covered import and export of goods and services, as well as the ECB guidelines. These are other two which I have in my mind, which we will try to cover it in coming months or so, and ESOP management. So we'll share our upcoming sessions and request everyone to participate. And I would want to thank, before getting on to the Q&A, I would want to thank my team members who have helped me and Maithili in formulating this presentation and then coordinating with SEB team. Thanks, Dhriti, Divya Jain, and Vijay Simha. And one last thing, before we get into the Q&A session, I have Mr. Vaibhav, who heads the startup practice at SEB. Mr. Vaibhav, if you can come up and share a few words about your practice.
Yeah,
Mr. Vaibhav?
yeah. I I was just waiting whether I'm audible, right?
Yes, you're audible. Please go ahead.
Great. So thanks a lot, everyone, for joining this call. I'm sure there are a lot of experts on this call, Anveshan's team and Kadir, and there are various other chartered accountancy firms and clients. I'll not take much of your time. I know the call is about to get over in next 2-3 minutes, but I'll just take you through what SCB does for its clients and partners like Anveshan and other partners with which we very aggressively and thoroughly work. So SCB is one of the oldest and largest MNC banks which is present into India. We are present in more than 60 geographies. It includes Southeast Asia, Middle East, and some African regions. We are also present in Europe and US, but mainly for our conglomerate clients. We are a full-fledged retail as well as commercial bank. Just to give you a brief, we acquired American Express Bank here in India. Now American Express is just a cards company. We acquired ANZ Grindlays Bank. We also acquired some part of RBS when RBS was exiting India, right? And there are a couple of regional acquisitions also which we have done in our last 170 years with in India. Uh, I come from MNC and startup team. I head the South region for the team. I've been working with the bank from past 13 years. So all throughout a non-individual banker, where my teams and my expertise along with Kadir comes. If there is any FEMA related transaction which you are doing or where you get stuck, we can ensure that we revert to you within 24 hours with help of Kadir and one more colleague of ours, Sanjay Dambir. So these two guys are pillar for us when it comes to FEMA. If you are a D2C company, if you are a startup, you want to do FDI, ODI, ECB, the turnaround time at SCB is the lowest because of help what we get from Kadir and Sanjay. We ensure that we get the documents first time right. and we try to, kind of resolve those queries for our clients and our referral partners. Third, with respect to the team, we have a very lean team. We don't have like 200, 300 people in my team, but we have 7, 8 people here in South. We have 7, 8 people in West and 7, 8 people in North. We are a team size of 28 people right now, mainly focusing on startups and MNCs. Apart from that, we do not have any other clients which we focus on, and we ensure the experience improves. With respect to service, we have enough service managers to take care of your request. And as a bank, we are much more capable enough to handle your transactions than compared to Indian banks and some of the foreign banks as well. We are very transparent when it comes to our foreign exchange transactions. We can do very complex transactions as well. And we also, in certain cases, help our clients in structuring certain transactions like ECBs. Normally, people have this habit of bringing ECBs in US dollars, but sometimes we go and advise our clients to do that ECB in INR and show that pros and cons of that particular thing as well. And yeah, so that's it from my side, probably. Radhika, would you like to add anything? Radhika is part of my team. She is one of our senior resources here in Bangalore. She takes care of entire South relationships for us and key relationships like Anveshan and Sundaram. So yeah, Radhika, over to you.
Yeah, thank you, Vaibhav. Firstly, I would like to thank Arun, Maitli, and Kadir for such an insightful session. I think the discussion overall it was very important in terms of the ODI, where we got to know the practical aspects, and Vaibhav more or less covered about the offerings of Standard Chartered Bank. I would just like to say that we are very well versed with our FEMA compliance, any transactions related to forex, any complex deals. We are happy to help you. We are partnered with Anveshan for a very long time, and we would continue our services with them. You can reach out to us directly, or you can reach out to Maithili or Arun sir via them. We can take up your queries. So that is it from my end. Anything if Kadir
One
wanted to
more,
add?
yeah. Kadir, before Kadir adds, we are very transparent in our approach, Arun, and everyone on the call. If we know we cannot do anything on a case, we will tell you upfront. We will not waste your time, right? Okay, sir, you've sent your query. Let me come back to you in 2, 3 days. I'll waste your 2, 3 days, ask you some random questions, even when I know that I cannot do it. So we are very upfront in our approach, and that's where we have earned a lot of respect within this fraternity. And now clients and CA firms and law firms, they come to us. I'm sure Kadir would manage at least 300 to 400, and Sanjay, similar case, 300 to 400 queries in a month. They would receive at least 10 queries in a month. So within the bank, we have done an idea bank, right? So now we have an Excel where there would be at least 1,500 queries which people would have asked. So we have noted it down. We have given the resolution. So even a Radhika can go there and do a control F and tell you few things about whatever query you are asking. So, and of course, feedback is important. Let us know wherever you want us to improve. If you have some past experiences, we would definitely be more than happy to improve. And over to Kadir, probably. Yeah. So, yeah.
Yeah, first of all, thanks. I would be hearing out the questions from the participant because the time is passing out actually. One last
Yes.
thing I just wanted to tell about SCB that the people might think SCP is a foreign bank, they would be charging more on this filing, etc. I'm giving you one thing that we are not charging any single amount for any of the filing which you have made on behalf of the client. Assuming there is an FCTPR, FCTRS, Form ODA, Form ECB, we are not charging single amount from any of the client. It is fully free of cost. That just wanted to tell because people in the market mind that being a foreign bank, Standard Chartered, they would be charging more on this aspect, but we are not charging any single amount. There are many more advantages which Standard Chartered Bank are having, but I don't want to waste that time actually. So let them ask the questions which they wanted to clear from their mind.
Yeah, thanks, Mr. Vaibhav, Ms. Radhika, and Mr. Kadir. Thanks for your time. So, without wasting much time, I would want to move ahead with the Q&A questions. First, I'll read out the questions that have already been posted in the group, in the chat group as well as Q&A. The first question from Mr. Vinay is: in case of step down subsidiary, what is the process to intimate RBI? Mr. Kadir, if you would like to answer.
Yes. Yeah, so if you see earlier FEMA 120 regulation, there is a time limit within 30 days of creation of step-down subsidy. They will have to intimate by way of separate plain paper reporting, and also that has to be reported in the form APR. But as per the revised OI 22 regulation, any creation of subsidy has to be reported by way of when they are filing APR. So there is no separate filing is required. Only at the time of filing APR, there is a column which is given. So they have to mention a creation of step-down subsidy, what is the remittance made for acquiring equity share, etc. So the reporting requirement is only at the time of filing APR.
Yeah, thanks, Mr. Kadir. We'll have one poll on our as part of our feedback system. Parallelly, the next question would be from Ms. Bhumika. Her question is, if we want to take remittance from Pakistan, do we take any approval?
This is FDI or investment? ODA? Sorry. I'm unable to hear.
I think it is actually remittance into Pakistan. Um, I think it just came out wrong because it is otherwise it would classify it as a thing. I think both cases it actually is covered under approval route. I think because we share borders with
Yeah.
the
It's
countries.
very clear. It's very clear in the regulation that has to go under approval route.
Exactly. So the next question is, what about cases where there is no deferred agreement entered and the bank account is not opened even after 12 months after incorporation in the US? In that case, should the client go for condonation? Kindly clarify.
See, they can go for continuation since there is a violation of FEMA because the subscriptions have already acquired the shares where payment was being made after 1 year. So they will have to make a deferred payment agreement with a backdated now and to make the remittance to regularize. So that is the only way to regularize. When you before going for continuation, the respective lapses needs to be regularized first. So the regularization should happen first. Post that only depends on the delay, the continuation or the late submission fees if they have done before August 22. Otherwise, it will be go for compounding. That will be a separate procedure to handle a closure of non-compliance. So if client is willing to go, they can go now and file the regularize that and make the LSF to complete the transaction.
Got it. So the next question is from Mr. Rohit. His question is, what is the option available if there is negative net worth for LLC? Net worth of LLC is less than initial investment made. How to transfer the amount now? What is the possible option? So I think Mr. Rohit, you're referring to say that if you want to make further investments into that LLC where the net worth is gone down below the initial investment. But here we also look at the valuation report. If the valuation is based on fair value basis, we generally see that startups also have negative net worth, but their valuations per se is much higher. So net worth may not be a guiding number or guiding principle here. We will have to look at the fair value valuation. So, moving on to the next question by Mr. Madhusudanan. In certain ESOP schemes, there are no subscription exercise amount. That is, the shares are allotted for the services provided. Will such ESOP schemes also be considered for LRS limit? So, Mr. Madhusudanan, if there is no subscription or exercise amount, certainly LRS limit doesn't change. It remains as is, varies. So, because there is no movement of money from India to overseas. So your balance limit remains as it is. Mr. Avinash has next question. What will happen for real estate investment, which is based on invest and will be leased back to other hotels to operate from ODI LRS perspective? So, Mr. Avinash, if we understand correctly, in this case, you want to invest in real estate or the client wants to invest in real estate and hold it and lease it for hotel industry. So if it is for leasing alone, we don't per se prima facie, we don't foresee any restriction. Only buying and selling is restricted. So, however, case to case basis, we will have to review and understand what is the purpose with which the investment has been made. The next question is by Mr. Abhishek Shetty. We are dealing with ODI where Indian LLP will invest X amount of money in foreign LLC. Later, the LLC will subscribe the shares of private limited company registered in India. But the same person has significant control in LLP, that is investing in LLC, as well as a private limited company in which LLC is investing. Whether this transaction leads to round tripping. So this is the question. Maithili, you want to take
Yeah,
that?
I think it is anyway a round tripping, but it has been enabled under the ODI corporate structure. So I don't foresee any specific thing. The only with regard to if it has not been an LLP and there is an Indian individual who is making the remittance, then there is a requirement where we need to be careful about. Otherwise, the corporate structure, the whole structure has been vetted by the government from this enabling round tripping perspective.
Yeah, thanks, Maithili. The next question is by Mr. Vignesh. Any annual compliance requirement for residents individuals for OPI transactions under LRS route and form OPI needed to file? Should it be filed? Then to whom it should be submitted? Less than 1% and no control in foreign entity. Is it clarified as is it classified as OPI? In that case, form OPI needs to be should form OPI needs to be filed. Mr. Kadir, you want to take this up?
Yeah. See, first we need to understand what is OPA, what is ODA. Okay. So ODA is when they are subscribing to an unlisted entity by way of subscription to MOA or by way of acquiring foreign security. Whatever the question, if they asked 1%, if it is an unlisted company, then ODA regulation comes into picture. There is no concept of OPA. If the individual is investing less than 1% of the listed company shares, that will be qualified as an OPA, and there is no requirement to file any other form OPA, etc. Form OPA, which is required to be filed by the Indian entity when they are making investment into a listed entity, then form OPA to be filed, or their employees have received ESOP shares from the foreign entity, then there is a requirement to file form OPA. Otherwise, on individual capacity, if somebody is making remittance on individual capacity into a listed company shares or into a fund which is registered and regulated by the host country, those would be called under OPA within the limit of LRS 2,50,000. There is no further filing requirement to be made with respect to FEMA regulation.
Thanks, Mr. Kadir. A few more questions we have. One is Mr. Vinay is asking when there is a merger and demerger or acquisition of Indian entity which has ODI, then what is the process for intimating RBI? How do we get to know if all, and next question is asking, how do we get to know if all FLA returns of the Indian entity has been filed or not? Because I think there was change in firms portal and from that perspective, I think he's talking about.
Yeah. See, when this ODA regulation comes into picture where Indian companies acquiring foreign securities by way of merger, demerger, etc. There is no other way to know by the AD Bank or RBI unless the Indian company comes and file Form FC. Okay, because the merger is happened between Indian company and a foreign entity, wherein AD Banks or RBI's role is nowhere it is required. When the Indian entity is acquiring foreign security, there is a requirement to file Form FC. So by that time only, the company will approach AD Banker and obtain the necessary UIN for that merger or acquisition. With respect to FLA, similar to that, FLA is the filing which will be done by the client directly to Reserve Bank of India. That is not through AD Bank. So unless similar to that, unless the client has to report the proper reporting, RBI may not know the actual picture of the company status. So it is the responsibility of the client to intimate to the RBI or AD banker whenever such demerger, merger, which has happened and changes to that, which affecting their company's balance sheet.
Thanks, Mr. Kadir. The next question is from Ms. Neha. Her question is, safe note investment made by foreign citizen who is resident in India. What are the applicable ODI regulations and compliance? I think whether the person is foreign citizen or Indian citizen, as long as they are resident in India and become residents as per RBI regulations, all the regulations that are applicable to Indian citizen apply to foreign citizen also. So I think I have answered that question myself. The next question is by Mr. Srinivas Kulkarni. For startup raising funds to acquire overseas company and want to acquire in the first year before audit, how does it invest? That's a very interesting question. So I think audit has to be done, interim audit. Please talk to your auditors and then get it audited. And then based on the net worth, you can always invest. And for startup raising funds in the first year of operations, want to acquire, yeah, so it's the same question, I think, repeated. Yeah, there are a few more questions. One is by Ms. Vibha. If is FCTRS required for Indian residents in case of strike-off liquidation when there is no distribution of assets, transfer of funds? Mr. Kadir, I think this is for uh, uh, you to answer.
First of all, FCTRS is, I'm not sure exactly,
Yeah,
FCTRS requirement
In
won't be
FDI.
applicable under OI rules. So the question is
FDI.
not clear.
FDI
Is it
rules.
So
which company is getting
think
liquidated, etc.?
so. Can we unmute Vibha if she can to speak out? I think my team has unmuted. If you can raise your hands and then ask your questions, we
Yeah.
can spend
So,
another 5 to 10 minutes.
so basically, is there any requirement for filing a form in case of liquidation of a foreign company? Uh, and
Yeah.
Indian just have liquidation.
So liquidation of the foreign company, that will be one of the method of disinvestment. Okay.
Yes.
Disinvestment can be selling of foreign company shares by the resident or closing down the foreign entity by way of liquidation, whatever, winding up, etc. So that will be qualified as an disinvestment, and the Indian company needs to get back the money from the overseas. In case if there is no money to be repatriated, okay, they will have to provide the audited financials, and accordingly, we will have to see what is the amount has been written off. On basis that write off, the AD bank will take into consideration, and you will have to file the disinvestment reporting to close the UIN.
One more query from Mr. Pradeep Shetty. His question is, any requirement to file semi-annual OPI forms for investment into Gift City? I think it is very
Yeah,
specific to Gift City.
yeah. See, the Gift City will be considered as an offshore entity, though it is in Gujarat, that is considered as an offshore entity. So any investment which is made by the entity into Gift City, as I said earlier, Form OPA is applicable only where an employee of Indian company is acquiring shares from the foreign entity, or when when Indian listed company is investing into a listed foreign entity. Assuming if a foreign listed entity which is situated in Gift City, if Indian entity is making remittance to Gift City under OPA, yes, they'll have to file OPA as well. So Gift City will be considered the entity which is situated offshore outside India.
As
So
an
whatever rules
overseas.
applicable offshore
I
entities,
understand.
that would be applicable for entity which is in Gift City.
Yeah, thanks, Mr. Kadir. I think there is one query on MTM trade. Mr. Saurabh, if you can unmute and ask your question. Mr. Saurabh, do we have you here? So, Mr. Kadir, the question was, just a minute. Saurabh. His question was okay. His question is not complete. He says some specific query on MTM. Maybe I'll connect you to him or him to you a little later. And the last question, I think, is it compulsory to obtain UIN and valuation report for safe investments? I think Ms. Neha, Mr. Kadir had explained the conversion ratio has to be fixed, and safe investments per se not really have the conversion and the value conversion fixed at in the beginning, and hence he was stressing upon that it should be in the form of CCD or CCPS or equity and any other instrument which has clarity on the conversion at the time of investment itself. Considering that, I think valuation also is required. I think we have covered all the questions. If there are any further questions, request you to unmute and then ask your questions.
I had one query. So, in case of optionally convertible preference shares was issued initially, at that point of time, valuation report was not required, and obviously conversion ratio also is not established. But at the time of conversion, if the value of the company is negative, then how will the conversion ratio be decided?
And so just want to understand, this is with respect to FDI, what's the offering convertible preference share?
I mean, if in case like loan was given, and that loan they want to convert into equity.
Okay. So when the pricing to be determined only at the time of converting into equity, assuming there is an OCPRS instrument which is issued by foreign entity 2 years back. Okay. Now they wanted to convert that loan into equity. So today when they are going to convert, what is the value today or not more than 3 months prior to today? So then you will have to see, and you accordingly you'll have to get the number of equity shares of the foreign entity.
Okay, so but if it has negative net worth, I know we can do valuation based on the DCF method, like fair value of the company as well. But if still the value of the company is negative, then at what price will the conversion happen? Should we
So you
consider
mean
the
to say
face value?
the negative valuation of the foreign entity?
Yes, I mean zero basically. The net worth of the company is zero, and if they do not plan to have any further
When the
business.
I just want to understand, when the value of the company is zero, then why they necessarily needs to obtain the equity shares? Value itself zero, no?
Yeah, but for like this, I mean, basically the value of the company is very less, so that's the point. If it is even less than the fair face value, can it be done at face value?
So that you need to see as per the host country regulation. Can anybody invest less than the face value as per the host country regulation? It will be allotted. So as per the host country regulation, if you assume there is a face value was $1, so can they allot new shares at less than face value? You will have to see that also. Everything will have to see, and pricing guidelines have to be complied because as per the OI rules and regulation, it has to be as per the price certified by CA. Assuming if the fair value is given 2 rupees, where the face value is 10. As per the OI rules regulation, they are allotting shares at a fair value of 2 rupees, then it is fine. They can get that many number of shares against the outstanding receivable.
Okay, okay, thank you.
Mr. Vignesh, if you can unmute and ask your query.
Hello.
Yes, Mr. Vignesh, go
Yeah.
ahead.
Yeah. See, we have it's a resident individual that's made the investment to US. as a unlisted shares, which is a venture capital. So it is so whether it is classified as a ODI, even it is a less than 1%, and there is no control as per FEMA rule. So whether but we have given the declaration to the banker, it is a OPI declaration, and
That is
within
what,
the
see,
LRS limit.
I understand because this was the case which was happened prior to August 2022 regulation. The banks have processed the transaction basis the declaration received from the client. Client is telling that I'm investing into a listed company. This is considered as a portfolio investment, etc. But after 2022 OA regulation, the definition which is very clearly given that irrespective of the percentage, if somebody is investing into an unlisted entity, then that is qualified as an ODA. They'll have to obtain UIN. If any client who has done the remittance prior to 22 and obtain and do not obtain UIN, now they'll have to approach to the AD banker and obtain the UIN to regularize.
Okay, but banker not asked any UIN number. Without that, we have transferred that.
Because you have given because the client has given the declaration stating it is considered as OPA.
Yeah, because we have shared the documents, so banker has gone for a vetting, and based on that, they asked the declaration.
No. As of now, that's what that depends on bank to take a call. We are more compliant into that. We are going to deeper, and we ensure that whatever remittance is being made, whether it is an actual OPA or ODA, accordingly we'll have to give the guidance to the client.
Okay, sir. And ODI, we have any complaints requirements? ODI.
ODA, there are a lot of complaints. Yes. ODA, there are a lot of complaints requirement is there. ODA, there are a lot of compliance is required that we'll have to see whether that individual is subscribing to the MOA of the foreign entity or if they are investing as an additional capital, and we'll have to see what is the valuation of the company, whether the remittance is being in synchronous with the valuation of the company. And post remittance, there are requirement to file regulatory document. So there are little bit regulatory compliances more with respect to ODA, but still as an AD bank can able to guide what are the things needs to be done prior to making remittance, post making remittance. So all those things we can able to guide on the client.
Sir, one more question is that we have a foreign account in foreign country for a residence in individual for remitting the LRS payment, and through there we have making the additional investment in other countries. Okay, for the whatever we are 2.5 lakh USD we have transferring, we are not investing, but whatever the remains money is laying in that is considered as a capital investment, which is amount is laying in our saving bank account in foreign country.
Yes, the rules are very clear. I just want to understand when you are making remittance to foreign country, what was the purpose which was declared by you?
We have it is for the opening bank account.
Opening bank account does not the right end use of the what is the end use of the fund which you are making remittance?
In end use, we are not given to the banker, but we have.
That's what bank to banks. The bank is not clearly taken the details from you actually. Otherwise, they would have given the correct guidance to you. So ideally, there is no purpose called opening a bank account, though it is a purpose. But we'll have to see what purpose you want to make the remittance. Assuming you want to purchase a property, okay. You are in the frame of dealing or finalizing the deal with the seller. Okay. So by the time annual limit is going to comply, so that point of time you can send the remittance to your own to the foreign currency account. But the ultimate purpose would be purchase of property. So now you have made the remittance over there. So what regulation says, you should have utilized the fund within 6 months from the date of making the remittance. If it is unutilized, that has to be brought back to India.
If your case complied with that 180 days, what is the consequences for the individual resident?
There is no consequences. It is a non-compliance. You will have to approach to AD banker and put it up the case with Reserve Bank of India. Then only we'll come to know what is the consequences. So consecution is a non-compliance. So non-compliance, you are violation under FEMA. Okay. So you will have to regularize. So how you will have to regularize? You will have to approach through your AD banker to Reserve Bank of India. You need to provide the fact of the case that then you will have to tell the Reserve Bank of India, I have exceeded, I have kept this money for more than 1 year. Now I would like to return back the money. So to regularize the same, to cut down on the lapses on the part of me. So basis that RBI will provide you the response or provide you the solution for the same. As of now, till the time you are non-compliance, it is violation under FEMA.
Okay, sir. Thank you so much.
Thanks, Mr. Vignesh, and others also for asking interesting questions and then bringing the thought process on that investment. I think we have spent more than 30 minutes beyond the time that we had estimated. So I think next time we will revisit the timings also. I think it was interesting. It is interesting subject. I would thank Mr. Kader, Ms. Radhika, and Mr. Vaibhav for sharing their knowledge with us and helping us maneuver all these compliance matters, which are critical and very important. So I would thank one and all, and we will be sharing the presentation as well as we will share our coordinates, contact details of Mr. Kader, Ms. Radhika, and Mr. Vaibhav on the email for all the participants. In case if there is anything that if it is required, you can reach out to them directly, or you can reach out to them through us. We'll be happy to assist. I think this was very welcoming session by the participants. If I request one or two participants to unmute and then share your feedback, that will be helpful for us. Anyone who would want to share your feedback?
Yes, actually, this was a very interesting session. There were a lot of queries which we come across when we are working with such funds, and it was very good to know, and a lot of things were clarified. So thank you very much. Even in future, for the future, if such sessions are conducted, would really like to know and participate.
Thanks for your feedback. Thank you. And we'll try and see how we can come up with similar sessions in future also. We'll certainly make it happen. And with this, thank you note. Once again, thank you to the SEB team. I would like to end this session